Hi, I'm Michael Newrock, and in this lesson we're going to go over lot sizes and risk and reward. Now, this is just a basic overview. So essentially, when you open a order in MetaTrader and for your Forex trading, you open a certain lot size. The bigger the lot size, the bigger the amount you are trading per pip or per tenth of a pip every movement of the of price in the market. So if you're trading, say, one lot and it happens to be $1 a pip, then every time the market moves in your favor, that's a dollar up. But every time the market moves against your position, that's a dollar down. So, you really want to base your lot sizes relative to your account size. So if you've got, just $1,000 or less in your account size, then you should stick to lot sizes of zero point 0.1 or below. 0.05 would be even better, um, particularly if you're trading um, multiple positions, or say split positions and multiple trades. You want to trade even lower. If you've got, say, around a $5,000 account, then zero point 0.1 will be fine. You can even go up a little bit. And further from that, then just base your lot sizes on your account size. So essentially, the bigger the lot size, the bigger you can make, but also the bigger you can lose. So you always want to make sure that it's reasonable for your account size. Now, of course, if you're using the Trend Profiteer Trade Assistant, all of that will be worked out for you if you're using the money management. So you can restrict it to, say, 1% of your account size, and there's further information on how to do that. But essentially, the bigger the lot size, the bigger you're trading per pip. So therefore, the bigger you can win, or the bigger you can lose. Now, the other thing that I want to talk about is risk and reward. So we place our stop losses to not expose ourselves to any further loss. So what happens is, let's say we're wanting to enter a buy order on this particular trade. We're expecting / hoping that the price is going to move upward. Now, first of all, risk. Risk is where we place our stop loss. So let's say we place our stop loss here at, or say just under the stop loss, say 55 pips. So that would be around. We'll make it 144.50. So I won't enter an order. I'll just place the horizontal line here, and we'll change this to red because that is our stop loss. So let's say we enter the order here. The amount of pips from the market entry to the stop loss is the amount of pips that we are risking. So let's say that's 61 pips, say, plus your spread. So, but let's just keep it simple. Let's say it's 60 pips, okay? 60 pips. That is what we're risking. If we're trading one lot, which happens to be $1 per pip on the particular chart that you're trading, then you're risking $60. So if you have two positions open, then you're risking twice as much as that at that lot size. So you obviously want to have your lot size that is relative to your account size. So you're never risking more than a certain percentage of your account. So the risk in this case is 60 pips. Now, if it was a sell, then we would place the stop loss on the other side, obviously, but that's the same applies. Risk is risk. So risk is where we set our stop loss because we don't want it. If it does, if things just don't go well and the price just plummets down here, you want to have that risk capped at a certain amount that you are prepared to lose. if the price goes any further, then your trade would have closed, and you haven't exposed your account to a disproportional amount of risk. So that is extremely important. On the other side, we have reward. So let's say we wanted to place reward close to this high. So let's just place it around here, and we'll change this to green, and we'll set that to 147.60. Okay, so we're opening our order here. We're risking around 60 pips. That's as much as we're going to risk in this particular trade. And we've got our target here. So we have a potential of around 250 pips. Around 250 pips. So 60 doesn't quite go into 260. So let's keep it at, let's move it up to here. So therefore we're only risking, say, 50 pips. And let's just move this down here. Okay. So roughly now, just for the sake of the example, we're risking 50 pips, and our reward is, oops, take it back too far. All right, just for the theory here, our profit is 250 pips. So our target is 250 pips away from our market entry. We're risking 50. We are aiming for 250. 250 is 5 times bigger than 50. Okay, so it's a multiple of 5, which is what you would use in your Trend Profiteer Trade Assistant. But essentially, the reward is 5 times bigger than your risk. In trading, in anything in life, when you're doing it for profit or for your own benefit, you always want to make sure that the return is bigger than what you're risking. So you don't want to risk $1 just to gain $1. In other words, if you're going to risk $1, you want to be able to return several dollars. So the same applies with trading. We always want to have our reward to risk ratio as high a multiple as we can. So in this case, it's a multiple of 5. The other way of looking at it is what's commonly known as the risk reward ratio, which in this case would be 1 to 5. So it's just the opposite. We're risking 1 unit for 5 units. In other words, the reward is 5 times bigger than the risk. So that's all there is to it. Lot sizes, the bigger they are, the more you can potentially generate, but the more you're potentially risking. The lower the lot sizes are, of course, your potential returns will be lower, but your risk is much lower as well. So make sure that you do it proportional to your account, and with your risk reward, make sure that your risks are lower than your rewards, or in other words, your rewards are always going to be a multiple of your risk. So we're not going to talk about trade management or locking in profits as we go, but in an idealistic, theoretical way, we're looking at always entering trades when our reward is much bigger than our risk. So hopefully that all makes sense. Until next time, good trading, live well, and I'll see you soon.